Well, the SA Reserve Bank, like other global central banks, has been hiking rates quite aggressively to curb surging inflation. But with the outlook a little more positive, will consumers get some reprieve? That's the question. Nedbank economist Nicky Weimar doesn't think so.
During the course of last year, it was coming down very slowly. It probably declined a little bit more as we went into December to around 7%. And now this petrol and diesel price cut in January, which was a big one, just petrol on its own, on a month-on-month basis, that's a decline of over 8%. That will probably bring it down to about 6.8% in January. So then you're still miles above where the Reserve Bank would like to see inflation, which is for it to be stable between the 3 to 6% band. But what the Reserve Bank really targets is 4.5%, which is the midpoint of our inflation band. And you'll agree with me, 6.8 is still very far away from that. And they obviously would like to see a very firm and well-established downward trend in inflation before they ease in terms of interest rates. The other thing that is out there that they need to be aware of is, of course, the rand. Now, the rand actually started this year, ended last year, started this year on a slightly firmer footing. A lot of that has had to do with the fact that the dollar has weakened quite a bit. But we do know that the general expectation is that US interest rates might increase a little bit further. And as long as that's the case, the rand's very vulnerable. The Reserve Bank still has to attract capital to this country. And so as a result, they're not going to cut rates. That is just not going to happen. So we see another 2 hikes of 25 basis points in the first half of this year. And we'll probably have interest rates peak in March. And from there on, it's probably going to stay at that level. If inflation comes down very quickly, maybe we'll see a cut towards the end of next year.